Thank you for joining us for our second quarter strategy outlook titled Stalemate, which is a follow-on to our outlook at the beginning of the year titled Slaying the Dragon, and the thesis there was that this was the year that the Fed was going to finally be successful in bringing down inflation. So far, the economy, the labor market, the consumer have all been stronger than we had expected, and quite frankly, the Fed. But there has been some progress made. If you take a look at CPI here in the red line, it peaked in June and has been declining since then. But what's been driving it has changed dramatically. To that point, we've divided the components of CPI into two simple categories. Those that are highly volatile, those that are food, energy, commodity-based that tend to go up and down quickly, those are the gray lines. And you can see that it was those cyclical, those commodity-based things that drove this inflation up to the peak in June and then receded fairly quickly, and the baton was passed, if you will, to the green data series, which is services. And the two basic components there are shelter, predominantly rent, which now we're seeing relief, and labor, which we're really not seeing much relief there because this labor market continues to be exceptionally tight. Now, we've showed this chart a number of times, a number of ways in the past year, and that's the dislocation between how many people are looking for work versus how many job openings there are. The red line here indicates how many people are unemployed, and the blue is how many openings there are for those. And you can see this labor market has never been this tight before. Going into the COVID lockdowns was the first time that we actually had more want ads, if you will, than people unemployed, slightly. But as you can see now on the far right that's highlighted in yellow, we now have 5 million more openings than we do have people unemployed. We have 10.8 million job openings and about 5.5 million people that are unemployed and looking for work. This puts a lot of pressure on wages. That's the good news. People are employed and they're making more money, but this is obviously a problem for inflation and one of the sticky components, if you will, that is causing the progress to slow down. The silver lining to this, of course, though, is that with such a strong labor market and the consumer comprising 70% of the economy, this is also one of the main reasons why we think if recession is near, it's going to be very short and very shallow. Because typically during recessions, there's a lot of layoffs, a lot of job loss, therefore spending decline, earnings decline. Unemployment tends to go to 6, 7, 8, even 10%. Right now, unemployment is 3.6%. And as the Fed slows the economy, the first thing that will be destroyed is demand for jobs, not actually people losing their job, but the demand. Right now, 10.8 million openings will go to 9 million, 8 million, 7 million, 6 million. And so you will have a slowdown that will slow the economy, but there won't be as many unemployed people as we've seen in previous cycles, thus a short and shallow recession. Now, when will the Fed be done? When is enough as far as raising rates? The next page tries to address that because if history is any indication, the Fed is not finished raising rates until the Fed funds rate is higher than CPI. And here you see historically other tightening cycles. Fed funds is in blue, CPI is in red. You notice the blue bar is always above the red before the Fed finishes. If you look at the far right, this is where we are now. Fed funds with the most recent hike are now at 5%. Inflation has come down to 6%. Now you can get there one of two ways. The easy way, which is inflation coming down to be below the blue bar, or the hard way by the Fed continuing to raise rates higher than the red bar. We think it's going to be the easy way. We think the Fed is done. We think they've done enough, and we need to allow enough time. It takes about a year for the full effect of a rate hike to work its way through the system. To that end, we've just anniversaried the first quarter point rate hike. In other words, we felt the full impact of a quarter point hike. There's 450 basis points more of hike impact to be felt on this economy, so it takes time. Now, we're not the only ones that think the Fed is done. The bond market thinks the Fed has done enough too, and to that point, historically, anytime the Fed funds rate is higher than the yield on the 2-year Treasury, the bond market is telling the Fed that they believe they are finished and rates are going down. And that's exactly what we've seen here. We've seen right now on the far right where we've colored it red that even though the Fed just raised rates, the yield on the 2-year Treasury is going down. The bond market is saying, we think you've won. It takes time for inflation to be tamed. It takes a year for the full effect of a rate hike to be felt. We've only anniversaried one rate hike so far, the full effect of that quarter point hike. There's a lot more yet to be felt. Something else that's slowing the economy and what has been in the news and dominating the financial news in recent weeks is concerns about the banking sector. What we have here is a picture of Jimmy Stewart in that iconic scene in It's a Wonderful Life where there's a run on his bank. And what we have just witnessed is something very similar to that, only this is what bank runs look like in 2023. People don't show up at the front door of the bank, but rather they pull out their phones and transfer money. That's what we've seen. We've seen a crisis of confidence, a liquidity issue. No bank can survive 40% of their depositors showing up in the morning and wanting everything taken out. And that's what we've seen. Yes, there have been some mismanagements of durations of bond portfolios, but the fact is, this is nothing like 2008. This is not a solvency issue. This is not a credit quality issue. There's some liquidity issues here that have been fanned by some, let's just say, some panic, and that is going to subside. Deposits are going to be money good in the banking system. This is not a systemic issue. Now, what is happening that will have legs is that stricter credit quality, tighter lending standards, greater regulation are all going to serve as to really doing some of the Fed's work of slowing the economy. Essentially, it will be the effect of several rate hikes, having a much tighter sort of credit environment for lending. As far as asset allocation, at the end of last year, we talked about, for the first time in quite some time, adding money to bonds because we believed that yields were enough to be nominally attractive, and two, bonds could start acting like bonds, generating income. And to that end, at the end of the year, the aggregate bond index had a yield of 4.7%. And our belief was that when the Fed finished their work, that yields would go down and bond values would go up. And that's exactly what we've seen so far right now. Year to date, the aggregate index is up, total return of 2.8%. You can see the green component is appreciation due to rates going down, and the blue component is income. So bonds acting like bonds, providing income and safety. Now, shifting to equities, our belief at the beginning of the year was the Fed was going to be successful in slowing the economy, which in turn would put pressure on earnings and the equity market. We thought there could be another 10% downside before the market was finished. And to that end, right now, why we're not selling equities is the market's already discounting 2/3 of a typical recession. The average recession, the S&P declines 30%. Right now, the S&P is down 18%. So whether we have a recession soon or not, the market's largely discounting that already. And since we believe that when we do have a recession, if it's near, it will be shallow and short, we don't want to try to time getting out and getting back in, but rather stay the course with the quality equities that we have and be there, because when the market turns, it turns quickly. Now, so far year to date, we've been surprised at the strength of the equity market. It's been very unusual first quarter. If you take a look at what led last year and what lagged, this year's been an absolute reverse. By that we mean here in blue, we're taking a look at the sectors, technology, telecom, and consumer discretionaries, and asset classes, energy, Bitcoin. You can see that the very worst performing sectors this last year in blue are the mirror image this year. Last year's losers are this year's winners. And in the case of energy, last year's winner is this year's loser. In short, what has led this year are lower quality, higher growth, longer earnings duration, growth-oriented asset classes and sectors, things that do well when the economy is expanding and interest rates are going down. These, we think, are going to be trends that will unwind as the year progresses and the economy slows. This is a head fake in our view. We're staying with our posture of leaning into slightly more defensive sectors, and we'll save the opportunity to get more growth-oriented after we've seen the pressure and the damage that's done as the economy slows. So in summary, if recession is near, expect it to be short and shallow. Second, inflation is improving, but it's at the phase now where it's somewhat sticky and dependent on how quickly wages start to come under control and the labor market normalizes. Number three, the Fed's work is done. 4, banking issues right now are perception. It's nothing like 2008. It is not a solvency or a credit issue. Bonds, they're finally acting like bonds. And finally, equities, stay the course. They're already largely discounting a recession. When things turn, they'll turn quickly. You need to be there when that happens. Thank you so much. Be well, and we look forward to catching up with you in the summer. Cheers.